All right, Happy New Year, everyone. Welcome back to the last episode of Lunch at the Market for 2010. Can you tell what bowl game is on tonight? That's right, Florida State takes on South Carolina tonight, and I will be wearing this extremely fashionable shirt to our New Year's Eve party tonight to encourage those who have an opinion to share it. Florida State didn't look so hot against Virginia Tech in the ACC Championship, so tonight's game is probably a toss-up. Although we are used to playing the old ball coach since he was at Florida for so long. Enough football today. I'm sure we'll have plenty more football to talk about when Oregon takes on Auburn for the national championship. If you're in the local area in Winston-Salem, North Carolina, feel free to come by the office for the game. We'll be having a huge party that night. It'll be lots of fun. All right, today Tech Insider regarding SOHU. They asked us about the Chinese company that provides news, information, video content, entertainment, communication services, all via the internet. Think about the Chinese Yahoo. Okay, we tell you more about the site, but we don't speak Mandarin, and clearly the site is not written in English when you visit sohu.com. But the forward PE is reasonable. It's about 14.45. The balance sheet shows $16.06 per share in cash, $609 million in their war chest, and $0 in debt. Quarterly revenue growth is growing 20% year over year, but quarterly earnings growth is only 9.8% year over year. So it looks like the declining earnings story is the reason why you see the price action in this chart of the stock. Stock used to be $80 a share, now trades for only $63.75. It's down another 1% today. The decline has been hideous, and it actually broke a long-term trend line support that's been in effect since July of this year. It broke it pretty hard to the downside. So it looks like the next level to where that downside might stop is $58.20 or so. If you're aggressive, you could probably short SOHU down to that level, but protection is not cheap. Normally, when we say to go short, we like to buy a call against it, but you're talking about paying $4 for a call in the next month or two, which means that you need the stock to move more than $4 just to cover the cost of your protection. And frankly, that puts you right around the level we think you can get long again. So either A, short it with a tight stop, or B, what we would rather see you do is sell the January 2011 65.70 call spread. Okay, so this is like the opposite trade from the put spreads that we normally sell. This stock looks like it's going down, so we think you can sell the call spread instead of the put spread. Okay, sell the 65.70 call spread in January. You can actually get paid $1.40 for that trade. Great risk reward. You're going to take in $1.40 to risk $5. You'll be effectively on the same side as selling the stock short, but without the big risk. Okay, so we like limited risk, also limited upside, but you know what your risk is. Okay. Once the stock hits that 58.20 level or so, we think you can take the trade from the other side. So either sell the 55.50 put spreads or the 50.45 put spreads once it breaks 59. Okay? Do that instead of getting outright long the stock, because then obviously you get to roll your position if you're wrong, unlike being long or short where, well, you just either have to cover or sell to get out of the trade. All right. Thanks for the question on Twitter. Remember, if you mention us on Twitter and you name a specific stock, we'll cover it on Lunch of the Market. Trader Fractal asked us for a price target in January on Salesforce.com CRM. Well, we don't like price targets over that short a period of time, but that's why we sell put spreads, because we're basically betting that, well, we don't care what the stock does, but at least it won't go below, right, whatever level that we're short by expiration. In this case, for Salesforce.com, we're short the January 120, 115 put spreads, which are $10.35 lower from where the stock trades right now. Salesforce.com doesn't report until February 23rd, so you don't have any earnings risk in those spreads. But if January sells off hard, you're going to see names, all the big high-flying names sell off more, because if the whole broad market sells off, those names will be sold because there's tons of money in those stocks, and people are in and out of them pretty quick. All right, we also, of course, sold more Decker's 80-75 put spreads in January. We also have opened up and started a position in the February 75-70 put spreads. Now, for small accounts, okay, a couple $1,000, we did already roll down and out from the 80 short 80, 75 put spreads down to the February 75 70 put spreads in February. Okay, so we were short 80, 75 in January. We rolled them down and out. We added a couple contracts in most cases, and we're now short the 75, 70 put spreads in February. On the bigger accounts where we've got huge cash positions and it's not a big deal to wait it out, we are still short the January 80, 75 contracts. But I don't have that luxury in smaller accounts because you almost can't be wrong. Okay, so rather than let this trade get real dicey into January options expiration, the safe thing to do is just to roll down and out. Plenty of time premium left in the February options. Volatility from today's move, this week's move in Deckers meant that we got good prices for those to roll down and out. All right. Just so you know, on Deckers, they've actually got $250 million in cash on the balance sheet with no debt. $6.50 per share of the stock's price that it trades for is actually just pure cash. So despite what I think is an appropriate PE of 19, it's even lower if you back out the cash. Okay, the stock for Deckers actually has quarterly revenue and earnings growth of both better than 20%, which brings the PEG in at less than 1. They also report the same day on February 23rd as Salesforce.com, so it's going to be a while before we get any numbers on them. But the good news is we should see same-store sales in December for retail, and if we can get numbers out of places like Finish Line or Foot Locker that show good shoe sales, it should bring the stock back up. Okay, we also sold put spreads on other high flyers like FFIV, Fire, NFLX, Akamai, Chipotle Mexican Grill, all the hot stocks. We basically went down $10 and sold put spreads. So, for instance, F5, we sold the 120, 115, Netflix 160, 155, Salesforce 120, 115, 120, 115, Chipotle Mexican Grill 295, 195. You get the idea, right? We went out into January, went down about $10 in these names, and then sold the put spreads there. Okay. Finally, Deere. Another way to play the agricultural bull market. Today we put on a call spread risk reversal. Big surprise there, huh? For $4.60, we got long a 70-80 completely in the money call spread for June of 2011, and then we sold a 70 put against it. Actually, it looks like this. Okay, so we're both long and short at the 70 strike, and then we're short again at the 80 strike. Okay, on the call side. So long call spread, 70-80, completely in the money call spread, and then we sold the put against it. Structure cost us $4.60. At expiration, of course, it'll be worth $10, which means that our $4.60 will basically be doubled if the trade goes our way. It's about 6 months. I'll take 100% rate of return in 6 months. Really appreciate you joining us for today's Lunch at the Market. It's been an unbelievable year. We've got 1,560 people that are part of the Magnum Opus financial community on Twitter. We want to say thank you to all of you guys. We've got close to 100 subscribers on our YouTube channel. We thank you guys as well. We really appreciate everyone's comments this year. It's been terrific. We have some wonderful Twitter friends out there, and we really appreciate everybody. Hopefully, it's been a profitable year for you as it has been for us. We want to wish you a safe and happy New Year's tonight. Please, please arrange a way home before you start partying tonight. Be safe out there. Have a terrific weekend, and we'll see you next year in 2011.